So options trade with a risk premium, right? So the premium that is used the premium that you have to pay for an option is calculated based on this thing called implied volatility. And the way to intuitively think about implied volatility is that it's the market's perception of how volatile we are going to be, right?
In the future.
So it was only when we broke and we started to go that now suddenly everyone's like, oh my God, we could do 10% in the next 2 weeks. So suddenly that perceived volatility goes up. That's what we mean by implied volatility going up. When that happens, the premium that you have to pay for any option is a lot more expensive, right? So the problem you've now got is if you're buying just outright, whether it's calls because you're bullish or whether it's puts because you're bearish, you're doing it at a much higher implied vol. And what we generally see in implied vol is it tends to be mean reverting to some extent, right? So, given that it's a mean reverting thing, there's quite a decent likelihood of a vol reset, as you call it, where the implied vol will come back down to something like 2025. And if you just buy premium, even if the market's completely unchanged, you'll lose money through the fact that those premiums come down when vol comes down.
Brilliant. You are a great teacher, and that was very well explained. And what you just laid out is that there is a sort of third dimension to options that needs to be considered as seriously as the directional view.